Here we go. We are live at 5 in the ETF Think Tank. Thanks everybody for joining us. A crazy, crazy day, like every day it seems like. And here we are with Amazon coming out with earnings, and of course Apple coming out with earnings. So we'll have a lot of discussions around that, maybe, but maybe not, because we're here today to really talk about ETF entrepreneurship with Ron DeLegge. So with that, you blab a little bit, Cynthia, while I let some folks in, if that's cool.
Yeah, so I'm Cynthia Murphy, master blabber, I guess, head of research for the Tank. I'm really excited for today's show because I love Ron. I think he's awesome, and it's really exciting to have him on the show today. We'll talk ETFs, but we can talk about all the stuff that's bleeding in the market because we always do somehow. I think we're still Dan and I are running it today, so bear with us here.
I'm trying to see if it's live. And I don't know that it is. Check to see if you can see if it's live.
It says on mine that it is live. So
it's live. I see it. Okay, cool, everybody.
Thanks, Jonathan.
Wait, Jonathan just told us that we're live?
Yep, you did.
Okay, cool. But I got to figure out, as always, trying to figure out how to let people in so we can see their faces. While I do that, looks live.
So yeah, so while we do that, Ron, why don't you tell us a little bit about, introduce yourself, I guess, to folks who are new to you, which I can't imagine many people are. So go for it.
Yeah, so thank you so much for that cordial welcome. So yeah, I'm the founder of ETF Guide. I also run the programs at ETF Guide TV. Some of the folks on have seen it as audience members, but also you, Cynthia, being a judge on ETF Battles. You've obviously been a regular participant. Dan's also been a co-judge on ETF Battles. So that's been fun. And then I also do other programs like First Look ETF with the New York Stock Exchange. That's a monthly show. And all of that is available on our YouTube channel, also on the major podcasting platforms. We just added Roku and Amazon Fire TV, so you can see the programming there. Those of us that use any of those platforms. So, and then I'm also an outside contributor to a Financial Advisor magazine. So I contribute to their ETF news, and they've been great over there. They have a great team. And so, yeah, involved with a lot of different projects.
So before Dan kicks off the market conversation, on the ETF Battles show, do you see any correlation between the requests you get? Because I know the audience requests which battles they want to see, like energy ETFs or whatever, ESG ETFs. Do you see any correlation on what they're requesting to market action, or is there all of a sudden a bigger interest in alternative income ETFs or things like that, or is it just you never know what's coming? It's a complete surprise every time you get a request.
I like surprises, so we don't get enough surprises on the show in terms of like the ETF matchups. It does very much mimic, I think, market sentiment. So for example, like in 2021, we were seeing lots of battles with growth type of ETFs, like ARK-K was a regular on the program. And we had a lot of requests for that. And, tech related, QQQ, blockchain, crypto focused type of stuff. So, but yeah, it's changed. Now people are more interested in things that are more defensive, hedging against higher rates. So definitely the ETF battle requests that we get obviously reflect the audience sentiment and market mood, 100%.
And how do you are interacting with this audience, which I'm assuming is mostly retail investors? What kind of direct one-on-one interactions do you have with them, and what kind of insight do you pick up from those relationships?
Yeah, so it's by email, sometimes also by social media contact, and also of course with the YouTube comment section, which is where most of our battles come from. We curate those comments and find out which battles make the most sense. So kind of a mix. But as far as like meeting audience members, I haven't really had that privilege yet. Most of them are scattered about the globe, and we've got, audience members all over the planet. I'm surprised that some of them, tuning in from Japan or tuning in from Singapore, or, Europe or somewhere far-flung place. So it's just amazing how we're able to reach such a big audience, with the power of video and podcasting and all that. So, and then we've got some people that are, maybe, US residents, but living abroad. So we're able to thankfully connect with those guys too.
Oh, that's awesome. I'm glad to see, I see Jonathan turned on his camera. Thanks, Jonathan. Always good to see you on the show. Everybody, don't be shy. We like to see your faces. So let's talk markets just a little bit, Ron, and I'll let Dan talk. But for anybody who doesn't know, Ron has actually written 2 books, one about 10 years ago and one about 3 years ago. And so one is called Gents with No Sense, as in dollar cents, and the other one is Habits of Investing Gurus, or I forget the title. Something
Investing
about
greats, yeah.
Investing like the greats, right? So I'm just wondering, on the first one, which there's a lot of satire and just, conversation about the craziness of Wall Street. And the other second one about habits of people who manage to accumulate wealth and manage it well. Are there any lessons from your experience in writing these books over the last 10 years that help explain the markets we're seeing today? Like in your research and you're putting those books together, anything that help us make sense of the markets we're living through today?
Yeah, the markets are always going to be different, different era, different time, but the people and the craziness, that's sort of a constant. And we all, to some extent, are battling our psychological demons. And what I've learned, I guess my biggest takeaway is we ourselves, as the poets once said, are our own worst enemies. And it's not the markets that are the enemy. It's not the Fed. It's not, war in Ukraine. It's not rising interest rates. It's none of that, Gerald Loeb was right. He said the market is shaped, or market prices are shaped by one thing and one thing only: psychology. And so it's market psychology or sentiment that shapes markets. Of course, there are other factors, but that's the primary driving, force behind market moves. I mean, you have algorithms and all that other stuff, but algorithms were, programmed by people. They weren't programmed by themselves. They didn't just arrive on the scene by themselves. So, that to me is the constant struggle, and I think that's, with Gents with No Sense, it was sort of a parody and a fun look at Wall Street, poking fun. I started writing that book in the aftermath of the financial crisis, just looking for, things that I could share from my own experiences, and also looking for some humor and just the craziness of it all. So also I used that book as an inspiration. A book that came out years before that, which was really how I kind of modeled the book, was Where Are the Customers' Yachts? One of my favorite books of all time. So anyone that has not read Where Are the Customers' Yachts, it was written, I think, about 80 years ago, I believe. And so, yeah, it's a great book. And, it's one that I try to read at least once a year. And then Habits and the Investing Greats, that was just, the whole idea behind that was I wanted to take one habit. I modeled that book. It has 26 chapters. There's 26 weeks, is half a year. And then the idea was that investors would take one habit and practice that for 1 week for 26 straight weeks. And then I matched up each habit with one investing great. So, I try to connect the dots and then let people take in that book what they could apply in real life, and then just practicing good habits. So that was kind of the idea with that. But yeah, writing books, anyone that's an author knows that it's kind of like having kids. Once you have the first one, you know, you kind of like, you're curious, what are these other ones going to look like and be like? And it kind of, you know, they keep coming. You want to, I don't know. I just think that's at least how I've heard it described. You know, it's like having kids, you know, you don't just have one, you want more. So
No, I'm good with 2, by the way.
you don't want more than 2
I
kids, Dan?
definitely
Come
do not
on.
want more. Yeah. So before I forget, by the way, the drinking word, we're gonna throw a
Oh.
curveball at everybody, right? Ron's got an interesting word.
Yeah,
Ron.
99%. It's not even a word, it's a number. I
Well,
figured
if you
this is
spell
Wow.
it, if
I
you
figured-
spell it,
I figured this is, you know, we're in finance. You know, we should be
I suddenly
talking
don't
not,
even know what we're going to be talking about then, but let's
Yeah.
go.
Yeah. So we're gonna use 99 or 99%. So I got to figure out how to somehow incorporate that into the discussion so that we could all have a drink.
Well, so of your 26 important habits, what is the most dreaded or the most difficult one to stick with to the 99%?
good job, Cynthia.
That's a good one. You know, it's tough to pick one good one. It's like asking, like, what's your favorite movie or what's your favorite song
Or what's your favorite kid?
or what's
Yeah.
your favorite kid? Exactly. You know, there's certain aspects of each that you like. So it's not going to be one. I will say, though, that one of my favorite stories in the book is Chris Sacca. Everyone know who Chris Sacca is? That's Saaca. Have we heard of Chris Sacca?
No.
Nope.
Tell
Never
us.
heard of Chris Sacca? Yeah, Chris Sacca, unbelievable story. I mean, this guy, you know, he was trained as an attorney, turned, you know, I forgot the exact figure. It's been a couple of years since I've written the book. I think it was something like, you know, maybe $12,000. No, I don't remember the figure, but he flipped it into like $12 million. So and then he went from 12 million to like -4 million.
Did he buy Bitcoin?
No, this was back in the .com days, but he just basically nuclear bombed himself with too much leverage and borrowing, you know, back in the go-go days. And so, but what's interesting to me is that he never, you know, even after that, I mean, that would just destroy most people. There's no recovery, you know, going from 12 million to 4 million in the hole. So he got a job at Google, started working there, and then flipped that into his own little venture capital firm. And then he started investing in companies that nobody heard of, like Twitter and Uber and a whole bunch of other companies. And so he's one of the richest guys walking around today. So Chris Sacca, real interesting story. But he's one of the investing greats too that I wrote about in the book. So, and then Muriel Siebert is another one. We wanted to include some ladies, you know, because I was looking at the book. I was looking at the vesting greats. It's like, we got too many old white guys. We need to get some, you know, it can't be the old white guys, you know. And even before Muriel Siebert was Ann Scheiber. Ann Scheiber, who gifted $22 million to Yeshiva University. I mean, you want to talk about a beast of an investor? Ann Scheiber, look her up. So I'm just ever impressed, regardless of, you know, whether we're in ETFs or any kind of investing. I've always loved to study and read about how people made their fortunes. To me, it's just fascinating.
Yeah, my husband would say I'm one of the spending grades, but that's a different conversation.
Yeah.
Go, Dan.
Yeah, well, I'm definitely keeping my daughter away from you then. Anyway, that's just like a little private joke. So, do you have any great stories about ETF entrepreneurs, by the way?
Yeah, well, you know, I was thinking about this. I mean, I guess, I mean, I've been in this industry for like 20 years. So I guess I, you know, I've had interactions with lots of folks. I mean, shortly before he died, I had a chance to interview Peter Bernstein, you know, Wall Street historian. And in that interview, he told our audience that he was a big enthusiast and big supporter of ETF investing, and that he even owned ETFs inside his portfolio. Now, that was in the middle of the great financial crisis in 2008. And nobody was even sure if there was going to be a financial system the next day. And so to see somebody of Bernstein's stature calmly and confidently say, hey, I'm an ETF investor. I'm a shareholder. To me, that was very reassuring. And, over the years, I've enjoyed watching ETF naysayers and critics be consistently wrong about ETFs. I think probably one of the biggest, and it might be a shocker to some, is John Bogle, had such an inaccurate view of ETFs, and it's a personal hero. That just shows you your heroes can be right most of the time, but they're not right all the time. And that's just something Bogleheads just don't get. Your heroes can be right most of the time, but they're not right all the time. Sorry, Bogleheads. He was wrong about ETFs. He said ETFs are like handing an arsonist matches. That's what he said. And the context for that, because everybody forgot or wasn't even around ETFs, the context for that was Vanguard was on the cusp of launching their own ETF lineup. And there was internal debate about whether they should go down that route or whether they should stick with index mutual funds. And so Bogle was shooting his mouth off anti-ETF rhetoric. And so that caused a lot of stir. Thankfully, the folks at Vanguard didn't listen to that rhetoric. And Vanguard is the way it is today. It's in the position it is in today because they didn't listen to John Bogle about ETFs. So, just watching the anti-ETF, rhetoric and having all that be wrong. 2008, CNBC's Jim Cramer accused inverse ETFs of causing, market declines and, exasperating the market fall. That didn't turn out to be true. And isn't it ironic that we now have a Cramer ETF in registration, an inverse Cramer ETF? What sweet irony. It's just fantastic. So the ETF business is just drenched with all kinds of interesting curves and twists.
I met John Bogle once or twice actually. And he wasn't very tall, right? And I'm not very tall either.
Yeah.
And I told him what I did. I'm an ETF strategist, Mr. Bogle. Nice to meet you. What is an ETF strategist? He said to me. I go, well, I build portfolios and I help financial advisors and hopefully, we deliver a better product than just buying the S&P 500. No way. You charge for that? He said. You can't charge for that. No way. I said, listen, I charge 50 basis points. That much? He was definitely a character, that's for sure. God bless him. He did change the world, in all seriousness.
Well, yeah, and the ETFs are just an extension of his original principle. And one of the arguments that he would use, one of his favorite crutches, was that look at all that trading volume, QQQ and SPY, all that daily turnover, that's causing, retail investors are turning into day traders. Well, we all know that most of that trading volume is from institutions. Yes, it's not from retail investors. And besides that, my question is, for the long-term ETF shareholder, how does that hurt them? It's creating tighter bid-ask spreads. How is that bad? In fact, I could make the argument that all that trading volume is good. It's lowering cost for the investor in terms of trading costs. And so, I just, the thing is sometimes, innovators latch on, and he's an innovator. They latch on to certain things. The mutual fund, the structure of the mutual fund versus the ETF, we won't go into that today, but the mutual fund is a flawed structure. And I don't think that was something he was ever able to come to terms with at a public level. He would never admit mutual funds are a flawed product compared to the ETF. How is it, as a mutual fund shareholder, I should be responsible for the taxes of an exiting shareholder? How is that fair? That would never happen with an ETF.
99% of the time that would be wrong.
99% of the time I would agree with you. And now is 100% of the time that I agree with you.
So, yeah, but that's not rare. I mean, wasn't it just maybe a month ago or 3 weeks ago, the IMF put out this huge report. It made the rounds. I know we were asked to comment on it about ETFs and liquidity. What happens if everybody runs for the exit? ETFs are going to crash the whole system. I mean, this is the IMF talking. And so 30 years in, we're still fighting the same ghosts, you know?
Yeah.
As long as it's not the central bank of China, of Japan rather, you know, saying that and then dumping all their ETFs.
Yeah.
That would be really ugly. How did you come up with the battles of ETFs? I really kind of like that show, by the way.
Thank you. Thank you. Well, we've had you as a judge and Cynthia as a regular. So, you know, we started the program in 2020. And I just figured that, you know, the ETF industry is so innovative. I'm surrounded by some of the best innovators in finance that anywhere. And I put anyone in the ETF business that's an innovator, you know, right up there with the hedge fund business, private equity, venture capital. I mean, the ETF minds that we got are some of the best in the business. So I wanted to bring a program that I thought would be able to innovate and create something that would be interactive for the audience and also at the same time fun for myself and fun for the participants, the judges. And so we came up with that idea. You know, in 2020, my first two judges, Mike Akins and Dave Krincis, you know, they weren't sure about it. I wasn't sure about it. It was just, you know, a giant experiment. We were in the middle of the pandemic and everyone was stuck at home. So I said, you know, let's try this. And, you know, the rest is sort of history.
Yeah, and it's funny because David Krincis, whom I love, every battle, no matter what asset you're talking about, he always brings the wild card GBTC. GBTC is his answer to any portfolio problem and the best thing to invest in, which I think is hysterical.
Yeah, well, not right now, right now
Yeah.
he's cash and energy. So,
Yeah.
you know, and that's just his style of, you know, managing money. He's a risk parity guy. So, you know, he's momentum based. And so wherever momentum is, he's gonna jump there. So, yeah, it's funny. I've acknowledged that, and him and I have debated offline whether that makes sense or not. And he's always making strong arguments of, you know, even if I disagree with those arguments. But no, it's good. I love the different perspectives. That's the beauty of ETF battles, is it's not just one. Like, it'd be like if I did a program just giving my viewpoints on ETFs or dissecting ETFs, to me, that's a dull program. I don't want to watch that. I don't want to listen to one view. I want to hear multiple angles. And I want to hear stuff, the things that Cynthia's raised on the program, for example. I'm like, why didn't I think of that? I missed that point. Or what a great, you know, perspective or angle. So that's, I think, what the magic of the show, the formula. And listen, I think the big networks, you know, the big cable networks, these are the types of creative programs they should be airing. It shouldn't be just interviews, you know. So, you know, that's my angle on it too.
So
Yeah,
Ron,
I'll say from my experience on the show, what is a cool exercise is that, you know, for anybody who hasn't watched the show, you pick 2 to 4 ETFs and you have to go head to head with somebody else and debate the merits of these ETFs and figure out which one best fit whatever category or. And what's interesting to me is how many times I step in with this, like the minute I see the tickers, I already have in my mind which one is the winner. And once you actually get, and you're going to break down side by side what these portfolios consist of, how are they getting there? What are they doing? A lot of times, I'm surprised by who in the end we decide is the best. So it's a really just cool exercise to constantly be doing that due diligence, even on things that you already had decided was the best option, because there's so much innovation in the ETF space that the best option is a moving target, you know, in a lot of these segments.
Yeah, 100%.
So Ron,
99%.
99%.
Oh, I'm drinking. So have you ever like looked at an ETF and had a pet peeve about how it's been labeled? I for one, frankly, like the private equity ETF, of course, it came out right when private equity was hot. PSP is the name. And I just thought that the label was man. Maybe not.
Yeah, I think you hit a point that's really. I was trading tweets, I think a day or two ago with Andrew Beer, all about
Mhm.
this.
Mm.
He sent out a tweet about something about, wouldn't it be hilarious if the SEC started cramping down on the naming of treasury inflation protected bonds tips, and wouldn't that be funny? But yeah, I think it's a huge problem, not just in the ETF industry, but with securities in general. To
Mhm.
me, it's like the Beverly Hills housewife conundrum. 99% of them are divorced and single, and they're on a program called Beverly Hills Housewives. How does that make sense?
Lessons are all around us, apparently.
So, and I think especially with the leveraged products, and I've been saying it for years, Wall Street's overregulated and under-policed. These products don't need more regulation. What they need is just a little policing. And, why not have as a mandatory thing for all leverage products to have, the number of daily point of leverage, whether it's 2x, 3x, 4x, whatever, have that be mandatory in the product name in order to alleviate confusion. What we're saying is more uniformity to how the products are labeled. Uniformity, I think, is healthy. And so especially with the leverage products, I think that would create a lot less confusion. And I don't know why it's such low-hanging fruit. As a securities lawyer, I'm not, but if I was sitting at the SEC, and I wanted to really help the investing public to better understand these products, that would be one way to do it, was just to have more uniformity with specifically the naming of the leverage products. I think that's something that definitely should be done yesterday. But as far as the other stuff, there's a lot of head scratchers, Dan. Stuff that just makes you wonder.
Yeah. No, absolutely. Very often people think build it and they will come, right? Talk to us a little bit about tricks that about marketing ETFs.
Man, I've got a lot prepared on this. Well, listen, I've never launched an ETF myself, so I can only speak about the failures and the successes that I've seen as an observer. Okay. And we could have another conversation, a part 2 maybe. So I don't think I'll be able to cover everything. I'd say the first thing is a fan base. Before launching an ETF, I think you should first build a following. You need a social media presence. You need an email list. All the public resources that you can get for broadcasting your message. Why do I say that? Because that's where your shareholder base will come from, dummy. And so I'm not saying that you can't succeed in the ETF business without a following. I'm just saying that it's a lot harder to succeed without a following. Also, allocating resources. The ETF enterprises that succeed are allocating their financial resources correctly. And I don't see this being done correctly at a lot of firms, especially the smaller firms. For example, the firms that are doing it right, they are never in a position where they've overspent on accounting and legal, and they don't have enough resources to support the product post-launch with marketing and distribution. So just getting the allocation of resources correct, that's a formula that not too many firms are getting right. And I think that's important if you're going to talk about a successful launch. The other thing too, I would say, is looking good. We all want to look good, right? The beauty industry is a multi-billion-dollar industry. Well, how about investments? Should investments look good? You got to have good-looking fact sheets, good-looking materials, good-looking literature. I think that's underrated. And if you're a small ETF issuer, you should never look like it. Constrained capital is one ETF shop. One ETF shop, I think they're doing a pretty good job on from what I've seen on their logo design, their fact sheets, their marketing materials are very good. Alps ETFs is another firm that I think does a pretty good job with their fact sheets, their literature. And by the way, I'm thoroughly unimpressed with BlackRock. I think they have some of the most for me, besides their logo looks fine, the fonts look fine, but the way the information is presented, to me, it's the aesthetic and how I look at it, compared to other firms, it's bland, it's dull, it's visually unappealing. They could be doing a much better job on their fact sheets. Of course, they don't really need to do that at this point. They've got all the billions under AUM, but I think if you're a smaller firm and you're looking at who should I be imitating, definitely not BlackRock when it comes to marketing materials. I think they do better on some of the other materials than they do their fact sheets. Their fact sheets are atrocious, but some of the other materials and research that they've produced, I think visually it's a lot better looking than their fact sheets. So I don't know. I can keep going on this, but I think, we'll save this for maybe another discussion, because I've got bigger thoughts in terms of the ETF industry. I think the industry is focused on the wrong ball in a lot of ways. I think, like I said earlier, I think the ETF industry is great when it comes to innovating. No one's going to out innovate an ETF entrepreneur, but they're not so good when it comes to distribution. That's my undying belief. And I think you take a look at the mutual fund industry, they're arguably less innovative compared to ETFs, but they're strong when it comes to distribution. That's why they got $6.5 trillion in 401k plans. They didn't get that because they're fanatical innovators. They got that because they're fanatical distributors. And so the ETF industry needs to learn, well, if we marry fanatical innovation with fanatical distribution, wow.
Yeah, but if you take the 401k market out, would you still say that? Because there's reasons why ETFs are not in 401ks, and they're not just a lack of commitment to the wrapper. It's just actual barriers to entry, right?
But there has to be an industry-wide effort to collect retirement assets. And I don't see that. I don't see any. So ETFs, we can't get into 401k plan. Come up with a solution. Invent something. Let's see your entrepreneurial spirit. Start working on the distribution aspect of getting ETFs into retirement. Don't say, well, mutual funds have owned that space for years and years and we can't break in. You can't fix the existing retirement distribution framework. It was built for legacy mutual funds, legacy products. You got to build a brand new highway. When Elon Musk built Tesla, he didn't go to GM and say, hey, let's refabricate your shops, your manufacturing plants so we can build Teslas in them. He said, screw that. I'm going to build my own plants and manufacture and build my own highway. And I think that's got to happen in the ETF industry. There has to be more of a collective effort to penetrate the retirement plan marketplace. And right now I don't see that. And to a large degree, a lot of that is because the main players already have, their foot in the 401k marketplace via other products, via mutual funds. So, but I think that's a huge entrepreneurial opportunity for anyone willing to climb that mountain. I haven't seen anybody yet that's been willing to do it.
But Ron, that's the part of the if we build, right? Now, what about the part where the allocators have to come? Like, do you think that, there's also a mindset problem? Like, are allocators too stuck in the past, in the, Morningstar ratings? That's the category. It has to be 3 years. It has to have at least 100 million. It's all these traditional mutual fund thresholds and milestones before adoption happens. And we all say all the time they don't really apply to ETFs, but then when you're in conversation with allocators, that's exactly what applies to ETFs. So is there also a mindset problem where we can innovate all day long, but unless there's a mindset change on the adoption side, it's hard to move the needle?
It is. There does have to be a radical change in mindset, and we need to stop looking at these mutual fund ratings. Why? Because 99% of all statistics only tell us 49% of the story 100% of the time.
Oops, I got a drink.
Like that one?
Repeat.
99% of all statistics, write this one down, kids. 99% of all statistics, you can quote me on this. I just said it again. I could keep saying 99% because we can all drink.
Until we're all drunk.
99% of all statistics only tell us 49% of the story, 100% of the time. And so that means that the other 51% of the equation needs to be explained. And so I also think, by the way, that, you know, we've got to be able to, you know, rearrange the mindset, you know, of the investing public, of financial advisors. We need to unteach them the things they've been indoctrinated with, like Morningstar ratings.
So Ron, we've got a question here from Lily.
Yep.
So Lily, go for it, because Lily's
Okay, sure.
always great
Hi,
with
Ron.
questions.
Hi, Lily.
Actually, I wrote to you back in 2007, I think. I was just a newbie when it comes to ETFs. And I wrote to you and I said, I asked a really stupid question. I said, are ETFs open-ended funds? And you were so kind, you wrote me back. And
That's
so I
very
really
cool.
appreciated that.
Yeah, that's awesome.
Yeah. And then I remember there's a publication that comes for financial advisor, and there's a small section totally devoted to ETFs. And
Yes.
you were the editor, and I always take that section out and I would read it over and over.
That's cool. Thank you very much.
But anyway, well, I guess what I'm saying, it has something to do with what Cynthia said. You know, most of the advisors or clients that we talk to, they're always concerned about track record, volume, expense ratio. You know, those are the things that they're concerned about.
Yeah.
And another thing is, you know, you were asking, you know, like who has the best material when it comes to marketing. I think SPDR that has really good marketing because they have like really good charts and, you know, historical, you know, data.
Yeah.
You know, when you want to research their products. So
You're talking about the sector spiders?
yes.
Yeah, I agree with you. I think the sector spiders do a fantastic job. Yeah,
Right.
they got a great design team. And it's interesting too, because you look at their materials versus the mothership SSGA. SSGA's fact sheets, they've got, you know, not a lot of color. You know, it's just like green and then gray text. And, you know, I just wish they would add a little bit more color. But yeah, I agree with you. Sector Spiders does a pretty good job. And
I guess my last question is, some of the smaller issuers, do you see them being taken over instead of closing, you know, some of their funds?
yeah, well, it depends on what situation they find themselves in. If they're just kind of a zombie fund, I think then, you know, you're looking for a takeover, and it may not be where you actually make a profit on the sale of the business. You know, you're just glad to get rid of it because you don't want to manage it anymore. We've seen that. I can't remember, somebody recently was taken over that way. I can't remember who it was, but you know, it's tough when you're a small issuer. And this is where it comes back to, you know, the people and the firm behind the fund. I think that's where you really have to create a culture and a personality behind the fund. I'm not saying you should be a star manager type of approach, but you do have to have leading voices at the firm that are consistently in the public, that are out there, and that people see on a regular basis. And so I think that, you know, with so many ETFs being index linked, well, now we're starting to see more active products. I think we're going to start seeing more active managers, you know, in the public spotlight, explaining their thesis. You know, I think Kathy Wood does that, of course, you know, pretty good. But, you know, I think that helps. There's got to be a shareholder base that believes in the approach. And so when you're a new issuer and you've got no performance history, you've really got to sell that, because that first 3 years of life, if you're not delivering that performance that outperforms whatever that pure benchmark is for that ETF, you're toast, because no one's going to want to own that type of ETF. So while you're building that performance record, you need to be communicating the message post-launch. So, I do a show called First Look ETF with NYSC. The whole purpose of that show is to give ETFs that have just recently launched a voice, to give those products a chance and give them some exposure. Because the worst thing that can happen, I think, in the ETF business is to have a super innovative product not gain any traction or AUM, awesome investment thesis, but just have the fund not succeed because it's not being properly exposed or given that marketing push. And how many products have we seen that fall into that category where you're like, how could this product fail? The thesis is great. Maybe the team behind the fund is great, but something went amiss, maybe either with the performance or the messaging post-launch of that ETF before it got that 3 years of performance history. So that's my long answer. But we have seen, at the same time, like I said before, 99% of all statistics only tell us 49% of the story. We have seen some incredible success in the ETF business. And I think about ProShares. I'm sorry, not ProShares, PowerShares. PowerShares is probably one of the greatest examples, selling themselves to Invesco. And then you had Index IQ, which was acquired by, I think it was New York Life Insurance.
Yep.
So you've got pockets of success, but, it's not been consistent. And, those types of windfalls are very uncommon, I think, in the ETF marketplace. I have yet to see anyone anywhere, regardless of their entrepreneurial talent, become an ETF billionaire.
Yeah.
Are there any ETF billionaires that have become that way because of the ETF business? No, but there are billionaires that have gotten into the ETF business. Jeffrey Gonlock, he got his billions from all the other stuff, and then he got into ETFs. So I don't know why entrepreneurs, to be honest, what's the matter with you? I need to have a one-on-one talk with you entrepreneurs. Why would you pick the ETF business? What's the matter with you people? Because it's a low margin business, okay, with a high failure rate. If Milt Friedman was alive, Milt would probably lecture you all about this, because I'm sure there's an economic lesson. Milt would say, what's the matter with you? He's always preaching against the government, I love his analogies with the government. He's so fantastic. And if you put the US government in charge of the Sahara Desert, they'd run out of sand in 5 years. We need more people like Milt. But to the entrepreneur should be picking businesses with high profit potential and a high success rate. So
don't forget, Ron, when there is success for an ETF, it probably follows somebody who's going to copy it. But I want to bring a question to Ray, who's patiently been raising his hand.
Yeah.
Ray.
Thanks, guys. Couple unrelated questions, but as far as ETFs, the first is, do you have a number that you would consider critical mass of an ETF for long-term survival, and how long do you have to get there? And the second one is, as we've seen more active ETFs, ETFs historically have been completely transparent, but you've got some of these non-trans or semi-transparent structures that are starting to come out. Just your comments on those things.
Yeah. So the threshold that I've heard in terms of success, I guess it depends on what your cost structure is. If you got a high cost structure, you're going to need a lot more AUM, Ray. If you're running the ETF from grandma's basement and your overhead's low, then you don't need as much AUM, So I guess it depends on the firm, and how tightly woven it is, and how nimble they are in the beginning. So
Ray, we generally say that it's about 50 million that you can get liftoff.
Okay, that's interesting, because that's usually as an allocator, that's about my number too, is about 50 is what it needs to be investable. So
yeah.
And it might take you 3 years to get there, in which case you've got a real track record, So you got to have sustainability, is what we tell people, to build that 3-year track record to get to that 50 million to, be successful. Or better still, start with 50 million and then you're at break even,
Yeah. And what was your second question about the product
As
structure?
far as you've seen some people, because you're starting to see more active managers either have a mutual fund and then launch an ETF beside it, or move into the ETF space. And a lot of these, you're starting to see some of these non-transparent or semi-transparent structures. I think Citadel has one. They're different where you can't really see what's in it. Yeah, it's more like a mutual fund structure as far as transparency, as opposed to the traditional ETF structure where you can just put on Bloomberg, see what's in there yesterday.
Yeah, I mean, some investors may be uneasy with that, but I think it goes back to the manager's reputation. How much do you trust the manager? Is it a trustworthy shop? Do they have, a pretty good reputation? So I think if that's the case, then I'm okay with less transparency, because with too much transparency in an active strategy, we know what happens, right? It's not good. So I have no problem with the lack of transparency or semi-transparency or any of that. That's just how those products need to be built for them to properly work and deliver on their performance, the performance promises. Well, they don't promise performance, but whatever their performance goals are, that's how they need to be built.
But yeah, and I think that's a great question, Ray, because it's something we're constantly looking at. And if you look at the traction on the non-transparent and semi-transparent stuff, it's been surprisingly slow. And I think the whole concept of buy our home cooking and just trust us, we know what we're doing. There's no way for you to verify any of it or see if you even like the ingredients. It's a tall order from a marketing and sales perspective. So I think the immediate investor base there is people that are already investing in other products from these firms. So they are already, I guess, fans of what they're getting there. But I think to come from outside and just directly jump into a non-transparent ETF, at least from what we see in terms of flows, has been very slow. I think people are struggling with just this idea of just trust me as your wholesale spiel. It's kind of fascinating. But Ryan has a question. You want to jump in, Ryan?
Yeah, sure. Hey, Ron.
Hey, Ryan, good to see you again.
Doing good. My question is in terms of kind of the successfulness of the different ETF battles that you put up on the YouTube channel, website, etc. How do you kind of identify the keys to the ones that kind of pop off a little bit more than the others in terms of, different topics? Is it the guests that come on, the timing of when, whether it be days of the week or even just recency of topics? How do you kind of identify which ones have had a little bit more success in terms of viewership, clicks and such than others?
Yeah, I think it's a combination of multiple things. It's timing, it's the battle participants, some of our judges. I mean, we've gotten some ladies involved in the show. Originally, we just had a whole bunch of men. The ladies are great. They present well on television, and some of the viewers, even ladies, I have found like to look at ladies on TV. It's not just the guys. So I think that certainly helps to mixing it up. I think it's very topical. What are investors interested in? So I think
Really?
very impacted by market sentiment. And then
Yeah, I don't know. Okay. Yeah, I hear somebody's got their mic open. Just FYI.
It's Keith. Can you mute Keith?
They were supposed to be in the walkie shop program.
Okay, I'll mute him. That's good. Muted him. Sorry about that, guys.
Thanks.
Yeah, and we've also been expanding the show's distribution. So that's been sort of helping. I mean, most of our audience is YouTube, but we also distribute the show. You can see it at Interactive Brokers on their trading blog. We also distribute it. I was telling Dan and Cynthia, we just added Roku and Amazon Fire. So you can watch ETF Guide programs, not just ETF Battles, but also First Look ETF. And we've got First Look Extra, and Spotlight. So we're bringing all that programming to multiple, platforms to try to just get the most exposure And then of course we do the podcasting, you know, we spin off the program as a podcast. So you just have to be everywhere. And, you know, for me, I want to produce a broadcast quality program that rivals the best in the business. So Bloomberg and CNBC, I have a lot of respect for them, but I also want to prove and show to the world that we can produce better programs, and we can do it. I don't need a big budget to do it. I could do it, you know, and that's the challenge for me, is to prove that I can do it, not having a big multi-million-dollar budget, but that I can produce a high quality program that delivers high quality content from leading ETF minds. I just think that's such tremendous value. The ETF marketplace, the investing public, financial advisors need that. They need more critical debate. We can't just sit here and say, oh, it has an ETF label, it's wonderful. Oh, it's got an ETF label, it's wonderful, it's wonderful, it's wonderful, it's wonderful. We need more critical evaluation of ETFs. Just because it has an ETF wrapper doesn't mean it's great. And I think this is what we're trying to bring to the show.
Well, to be fair, as one of the judges, usually Ron does not pay for the talent. So that's why it's a low budget show.
Yeah.
But I
Well,
wanted to, you know, I wanted to go back. I was reading the comments here on the chat, and I'm really intrigued by this comment, Jonathan, that you made earlier. And I would love to unmute you and bring it up when we were talking about why ETFs, all that stuff. And you just said you never had a client ask or care about being in an ETF versus a mutual fund. I have never heard that before. So I'd love for you to come up and tell us, who are your clients that they're that much of a product agnostic, wrapper agnostic? I'm just curious about that. Can you unmute Jonathan, or I don't know if you can
Jonathan who?
yourself?
Which
There you go.
Donaldson? Okay.
Yeah.
He's got a great client base, by the way.
So a lot of our bigger guys are former MLB players, or just, you know, generalized doctors. So for the most part, I feel like whenever I explain the difference, I don't know if it's partially because of the financial illiteracy I think that most people generally have, but the differences don't really show themselves too much to them. And I think a lot of it got kind of going back to what Ron was saying of, you have to kind of trust some of the managers when you're going into a little bit of, when you don't have the transparency. I think I have that pretty well for the most part. So I guess that's part of it. We have a fairly concentrated client base. So I don't have, you know, 500 clients out there with all different views. It's kind of similar people, but I just feel like they don't really notice the difference or really care. They see it's a group of funds that hold either a large amount of bonds or a large amount of stocks, and that's really as far as they go.
Well, that's definitely a first for me. I've never heard of a client who didn't have an opinion one way or the other. That's fascinating. So
He
then
does a
for
good
you,
job.
like,
Oh.
do you find how does it go for you to recommend one versus the other? Does it all just come down to, are you going to be trading this thing and how much does it cost, or what's the criteria then?
I mean, a big deal just goes, you know, fund manager first, or the manager, you know, who am I looking at? What sector? Obviously I work with the think tank. So a lot of the products that get pushed are from, they come in. And so, you know, it kind of starts with the ETF, but a big reason for me is why not an ETF is generally the first question. So unless there's just some strong, compelling reason not to do it in that wrapper, that tends to be the default in the portfolio.
Well, and I'm sure ETF Battles would be a great show for you too. You should become a regular watcher.
Yeah, I'll have to get on.
Right, Ron?
Yeah, for sure. Yeah, I think, you know, it's entertaining, it's fun, it's educational. Listen, I learned something. I tell, you know, the audience all the time that, wow, you know, I'm just as entertained as you guys, and I'm a participant in this. You know, and that's the kind of program that I create, is something I would want to watch, you know, something that I would actually sit down and enjoy. So I think that's been sort of my philosophy. But it's interesting, Jonathan, that clients, you know, get that. You know, I mean, when you think about it, it makes sense, because they're probably familiar with stocks, you know, how stocks are bought and sold. So ETFs are bought and sold the same way. So it's not that that complicated. And then to that question of the transparency or semi-transparency or lack of transparency, see, that could be perceived as something negative. I think, you know, firms that have those kinds of products should be selling it as a positive feature. It's positive. That's what makes the product properly work. It has to be that way. So I think it's how you frame it, as opposed to it's contorted by, I don't know who out there, maybe the media or whoever else, as something negative, when in fact, in reality, it's not a negative thing. That's just how the product is, you know? So
Ron, our clients are mostly financial advisors, but tell me if I'm wrong. I find that your audience specifically is mostly retail. If that's the case, and correct me if I'm wrong, and whether I'm right or wrong is less important. How important is retail to a new launch as an ETF, right?
99% of
Yeah.
our audience. No, I'm kidding with you. Yeah,
Okay.
I would say, yeah, there you go. 99%.
Bottoms up. Mine is
Yeah,
empty.
Yeah, I would say probably the breakdown. I don't know specifically the actual breakdown, because, you know,
No, just
our
generally.
analytics don't get that granular, unfortunately. But I would say, I would agree that, you know, the retail is definitely a bigger part of that. And just by default, we all know that the financial advisor community is much smaller in scale and size compared to the retail investors. So there's a lot more of them than there is the financial professionals, but they both are, you know, a crucial, you know, aspect to what we're doing. And when we try to present the show, I do it in a way that would appeal to both groups, because
sure.
they're both important. You know, obviously advisors influence asset flows, so they're crucial, but retail investors, as we all learned with the whole GameStop thing, are becoming more of a force. And so I
Yes.
think, you know, that we haven't really seen that in a way that we can track in the ETF business. Like, it's not like we could, like, the media sourced, okay, here's where that GameStop craze came from, Reddit, you know, it's a bunch of crazed Reddit people, you know, that are in front of their computer all the time. So I don't think in the ETF marketplace, I don't know if that we've necessarily seen that. Maybe you could say with the ARC funds, I mean, they have a pretty crazy, like, hardcore constituency, you know, of folks that will never, you know, whatever Kathy says, it's like a cult, you know? So I think you have to sort of create, if you want to create success, you almost have to have like a cult, you know, even if they're wrong, they don't care. They're still sending money. You know, it's like Peter Schiff. Gold's gonna be $5,000 an ounce. Let me sell you some gold. You know, and Peter, you know, he's not worth $80-90 million for nothing. He's got that, you know, that pizzazz, that, you know what I'm saying? It's like a cult following. And so
we had him on our Spaces show this
today.
the
ETF business, you need to have that personality. You need to have that, you know, and so I think, getting back to what we were talking about earlier, you know, even before the embryo of an ETF idea is devised or it comes to your mind, you got to have that following. Focus on the following. That'll be your shareholder base. That's what you should be building from, you know. And it's almost like talent on Hollywood, you know. When they're starting to look for talent, maybe they go these days. They, you know, instead of coming in, they don't invite you anymore. They look on YouTube. You know, who's got the audiences are interacting with this YouTube content. Who are the most interesting characters? They look at folks with a following, and they somehow, you know, recruit that talent. And so I think in a similar way in finance, we need to see more of that, you know. And I think the great part about the ETF Think Tank is we have those characters with a pretty big following. You know, I'm impressed with
I think it's time to wrap it up, Ron.
Yeah. Yeah, so that's what you need, you know, if you're going to not just launch new product, but also the sustainability of products for the long run. Because if we're telling people to invest for the long run, then we need to have products that can stand the test of time and strategies that do the same thing.
Hey, Cynthia, before you wrap up, I just wanted to say, next week, guys, We have Lee Shaman, who is in charge of the Association for Bank Loans coming on. Very serious guy. He used to run SRLN. So this was a great show, Ron. Lots of fun ranting about, but I just wanted to let everybody know what next week is about. Sorry,
Oh, and
Cynthia, go ahead.
Before we wrap, I wanted to bring up Daniel from our title team. We have a couple really cool events next week that we want to make sure we invite anybody who would like to attend. So Daniel, go for it.
Yes. Thank you, Cynthia. Just, I guess, as a closing remark, if any of you ETF gurus will be at Schwab Impact next week, I'd love to meet you in person. We're hosting a couple of events. One is with Zega Financial, who uses options to hedge risk. We're hosting a lunch with them on Wednesday, and we're also hosting a happy hour with Adesina Social Capital, who is our ESG manager, on Thursday night before the final event. So you can stop by on your way. Please reach out to me or anyone else on the Think Tank for any additional details, and I'll pop my contact info in the chat box if there's any interest.
Yeah, so free food or free drinks and great company.
both.
So if you guys are around Colorado next week, Denver, right? I think it's Schwab Impact. Just don't be shy. We'd love to have you there. Ron, thank you so much. It's always great to see you, my friend. Thanks everybody for coming every week. This is our favorite day of the week for a reason. We love seeing you all, and we will see you next week. Have a great weekend, everybody. Thanks all.
Thank you.
Thanks.
Take care, all.
Bye.
Be well.